broccoli as well as your filet mignon. So I think the broccoli is usually is your fixed income and cash. It's a bad health outcome. So it's the same with your portfolio. You should never be too over allocated to one particular asset class. Investing, I think, is very much a confidence thing. Confidence tends to be driven by practice, and by education.
Welcome to the fourth episode of the Upworth Talks, the leading personal finance interview series with extraordinary characters brought to you for their inspiring stories and achievements. Before anything, I'd like to talk a little bit about what Upworth is. Upworth is the home of empowered individuals who want to take control of their financial life. We allow you to connect all your assets and liabilities, think bank accounts, investment accounts, cryptocurrency, mortgages, real estate and more, across more than 7,000 institutions. You can track your net worth in real time, access powerful insights, and take meaningful action for your wealth inside our platform. For instance, we scan daily all mortgage offers for you, and we alert you when we detect at least 10% savings over the life of your loan. You can then refinance inside our app in a few clicks. Our product is available at upworth.com.au for free. As a standard disclaimer before we start, Upworth does not provide financial advice, whether general or personal, and this podcast is solely intended for entertainment and informative purpose. The views expressed in this interview are strictly personal and should not be relied upon to make any financial decision. Please seek financial advice if you are in doubt. Today, we turn our attention to the world of listed investment. To put things into perspective, the combined value of stock exchanges worldwide is estimated at around 110 trillion USD, while global household wealth is estimated at around 454 trillion USD. Stock exchanges channel tremendous amounts of resources and a significant share of our savings, either through our direct investments or through pension fund and asset manager investments, the ones they do on our behalf. On-exchange investment is at a decade high in Australia, with about 38% of the adult population invested. That is about 7.7 million individuals. What are the most popular investments and why? How can they be accessed? What makes on-exchange investment attractive? What are the most notable recent trends and disparities in the Australian investor landscape? I am Alex Chaboutier, co-founder and CEO of Upworth, and I'm joined today to explore this fascinating topic by Andrew Campion, General Manager Investment Products and Strategy at the ASX, the Australian Securities Exchange. Andrew is a very seasoned finance professional with 2 decades of experience across the US, Australia, and the UK. He used to be a derivatives trader, lately at Goldman Sachs as an executive director. Andrew, welcome to our talk. Thank you so much for having us today at the ASX, and very pleased, very honored.
No problem. Thanks, Alex. Thanks for having me along to be the guest on Upworth Talks today.
Thanks a lot. Andrew, maybe to start, I talked a little bit too much, and this podcast is all about, your experience, the ASX, what we want to talk about today. You have had a fascinating career in finance globally on different sides of the trading scene. How did it all start? How did you get into it in the first place?
Well, I'm probably showing my age a little bit here, but I can sort of trace it back to high school days. There was a very popular movie that came out. I think I was in probably year 9, I guess, Wall Street. And myself and a lot of my mates thought, that looks amazing. And we didn't even know what a stock market was back then, pre-internet, etc. We maybe heard a little bit about it on the TV news of an evening, but that sounded very exciting. So I did work experience at a stockbroking firm in year 10. Really enjoyed it, sort of focused on economics and finance in my undergraduate studies, and that sort of launched me into a career in finance. I guess it's somewhat ironic because that movie was not supposed to portray Wall Street and the finance industry in a particularly good light, but in some ways it's sort of similar. One of my favourite writers is Michael Lewis, and you probably know his book Liar's Poker. And I remember him recounting a tale that he has just so many people over the years have told him, I got into finance after reading Liar's Poker, and he sort of scratches his head at that because it was not meant to portray the industry that he worked in at the start of his career in a favourable light. But I guess people take inspiration from many different sources.
Really nice. So from Hollywood to literature to trading, that was your passion from a very young age, apparently.
Yeah, I mean, it was interspersed with a love of travel. So I was, after finishing my undergraduate degree, I moved to London. I was fortunate enough to have a British passport, so it was made it easy to turn the standard Australian backpacker 1 year into many. So I was actually offshore for about 15 years in the UK and the US, and obviously places like London are some of the world's real global cities in terms of financial services. So very fortunate to have worked there for a big chunk of my career.
Shifting to that question, of like your role at the ASX, and then you focus very interestingly on innovation as well, products, how does it play out? What does it consist of? How do you avoid this kind of, mania creation as well, maybe? Can you walk us through a little bit that part?
Yeah, I mean, for the most part, we deal, the investment products that we offer to primarily retail investors. They're typically simple products. Usually use of leverage or use of derivatives is usually reasonably low. So they're simple products to understand. They tend to be, the way we want to approach it is that we provide enough products for people to build a diversified portfolio that approaches a sort of level of risk rate of returns that an institutional investor. I mean, the big players like the Australian supers, CBOS as well, they'll obviously always have access to investment opportunities that retail will probably struggle to. But we like to think these days it's come a long way to where retail investing was 20 or 30 years ago. Online broking and the competition there and the massive reduction in transaction costs helps. There's also the product choice as well. Again, I keep harping on the theme of diversification, but the products that we work with our clients, fund manager clients, to put on the ASX, give people the great ability to diversify beyond what they've traditionally been able to. So ETFs is a big part of that, but there's other products as well, like with listed investment companies and trusts, the same things. They're typically an efficient wrapper of a basket of securities that retail investors would probably struggle to access directly on their own, or if they could access them directly, it might be at a much higher transaction cost.
Really exciting. I mean, you're touching a bit on a question I wanted to ask you, which is someone like me who want to invest in the ASX, what is briefly the range of products that I could access?
I mean, from its simplest, we have ETFs that are cash ETFs. So literally, it might just be a more efficient way. If you want to hold a few shares and a few ETFs, you still want to have a cash allocation, but you don't want to have to set up a term deposit or a separate cash management account. You can still do that through your online brokerage account and put a proportion of your portfolio into a cash ETF, which just invests in term deposits or at call deposits with major banks, etc. So that's probably the simplest product. Then we'll go through ETFs or listed investment companies and trusts that invest in a broad range of fixed income instruments. For those that are familiar with capital structures of companies, debt tends to be a safer investment than equity. You've got first claim on the assets of the company. The equity holders have the riskier slice of the capital structure. They have more upside through profits rather than just an interest payment or a coupon periodically. And then from there, we probably would move up into diversified equity ETFs that either have an active mandate to outperform a well-recognised benchmark, or even just to track a benchmark like the ASX 200 or the S&P 500. And I think once you step up from there, there might be other types of products that have baskets of maybe somewhat more complex, like private debt, private credit, private equity investments that aren't quite as transparent as an S&P 500 tracking ETF. And then you probably get into the very end of the risk spectrum, things like warrants that typically have some degree of leverage. That's typically the spectrum of how we describe the offering of the investment products on ASX.
Pretty broad spectrum.
Yeah, it's a very we've just crossed just in the last couple of months. We now have went across a couple of round numbers in terms of the ETF market. We had our 300th ETF emitted in August, I believe, and we crossed $150 billion in market cap for the ETF market, which is up from about $25 billion. 6 or 7 years ago when I started here.
Okay.
I think this month, obviously, market's had a tougher month, so I think the total market cap's probably pulled back to being just below 150. But we're really proud of how many world-class fund managers want to put products on our market, and how much interest there is from all different types of investors to use those as tools to build portfolios. We've still got a long way to go compared to the global investment product markets, the ETFs in particular. I think just the New York Stock Exchange itself had their 2000th ETF listed there a couple of months ago, and the ETF market in the US is about 6 or 7 trillion. So we're a long way behind them, but obviously it's a much bigger, more sophisticated market compared to Australia, and they led the world in that particular type of financial innovation, being the exchange traded fund.
It's an interesting thought, because you may ask yourself, many people are very excited about US stock investment. It's very topical.
Yeah.
But I think you described quite a great range of products and opportunities. As a local investor, what are the benefits of investing in the ASX relative to other foreign stock exchanges?
Well, there's always going to be a natural home bias. People get very comfortable about investing in companies that they know. They may come out of Woolworths and they're doing their grocery shopping, see how much a basket of groceries costs these days. They probably frequently realise, wow, this is a pretty good business they have here. So they like familiarity. They like investing in brands that they use consistently. So there's always going to be that home bias, that home comfort, just from a philosophical point of view.
Yeah.
But there's other benefits as well. Tax is one. There's a couple of probably elements to tax. Australia has the dividend imputation system, or franking credits, franking system as it's commonly known as. So that provides a real benefit to avoid the double taxation of company profits at the company level and at the individual investor level. Franking credits are applied to any income that you derive. So that's quite unique. I think there's only a couple of countries around the world that have that system.
Very exciting.
That's only accessible to domestic investors.
A big advantage.
So that's a big advantage. Some people sort of query, well, is that actually a great outcome? Because we end up with this huge equity bias in Australia. Most people's portfolios, if they're self-directed investor, much higher equity allocation than a lot of experts or academics would suggest. With that classic type of portfolio construction that we've heard about for decades, the 60-40 portfolio, 60% equities, 40% fixed income and cash. That's if you looked under the hood of a lot of Australian investors' portfolios, they'd be much higher than 60% allocation to growth assets.
Yeah.
And some of that is probably driven by the treatment of company dividends here. That's one part. And then also just administratively, it's a lot easier if you're just dealing with the local tax authorities. We previously used to have ETFs that were cross-listed from another market into Australia through what we call a CDI, a CHESS depository instrument. But what that means is you're holding a US-listed security rather than an Australian-listed one. So what that means is you buy one of those things, and then a few months or weeks later you get a letter from the US tax authority saying, please fill out this form so we can keep track of you, and otherwise we'll withhold 30% or 15%, I can't remember, depends on the jurisdiction. If we have a tax treaty,
that means that.
Yeah, so then you've got to go about trying to get a refund on your withholding tax. So there's a real administrative burden in holding offshore securities. I mean, the technology is there. There's an amazing amount of broker platforms, interactive brokers, IG, CMC, that offer that, but there's still a bit of a flip side. There is some admin, some tax messiness that comes about that you just don't have if you hold all your investments through on a HIN, which is the holder identification number, which is if you open a brokerage account with an ASX broker like CompSec, Trade, Bell Direct, the HIN is your client identifying number. So that tends to be a very, very efficient way. Makes it easy. Plus, Australian investors really like that because also quite uniquely, again, it provides legal name on title. It's not just what's known as beneficial ownership. You have full legal title to any investments you hold with the HIN. Now, it's very unusual. It doesn't happen very often that a broker goes bankrupt. but it does provide that extra level of legal certainty that you have your name on title. You're not just in what's called an omnibus account with thousands or millions of other investors in the event of any receivership or liquidation of a broker. So that's also another benefit of investing through the ASX.
And additionally, I mean, you know that better than I do, so correct me if I'm wrong, but I believe like the historical reason of the ASX has actually even been better than S&P. I don't know that's not the case.
I think marginally, but that's over a very long period of time. I think over 100 years. I think you're right. Obviously, not many of us have a 100-year investment horizon. Some people barely have a 100-day investment horizon, but I do believe that's the case. Whether that, the old disclaimer that you see at the bottom of every investment PDS is historical. Historical performance is no guide to future performance. I'm a massive fan of the US market and the US economy. The innovation happens there, so I do look at our market and see a reasonably concentrated market here and just huge amount. Like when you look at the value, just in what they call the Magnificent Seven, the big 7 US tech firms. I think collectively they're tens of trillions of dollars, and most of those, and the old guy in that pack is Microsoft, which is only dates back to the 1970s. A lot of those firms are 20 years or younger. You just don't see that in other developed markets like Australia or Europe or
banks and mining here. Basically the main caps.
So whether we'll do that again over the next 100 years, outperform the US market, we'll see. But it is a very interesting fact. I mean, it just serves to show that for many reasons Australia is a great country, and I think a lot of that's just the equality of opportunity that we have here as well. It's been a big driver, and just the abundance of natural resources that we're blessed with spread over a reasonably small population as well. And our geography, we're in close proximity of what's been the fastest growing part of the world for the last 20 or 30 years.
No, and entirely, you said it, which actually, when you look at the data, it's pretty interesting because Australia is actually the wealthiest country on earth on a per capita basis for median wealth, which is an interesting one, right? Because it tells you about the distribution of this wealth. Obviously, like the average wealth is higher in the US, but it's incredibly unequal. Yeah. And so that fact, which goes to what you're saying, makes Australia pretty, balanced and healthy case, I guess.
Yeah.
Talking, before we move to the ASX Australian Investor Studies that I really want to go into, and that you released a few months ago. Last question that I was burning to ask you, what have been the sort of the biggest success stories on the ASX, in terms of like listing and strong performance, some iconic stocks or some very high performing stocks?
I think some of the big mining names stand out. BHP, I think, is the longest serving stock on the Australian market. It goes back to the company was formed in the 1860s, I think, but I think it's been on one of the precursors to the ASX since the 1870s, 1880s. So that's obviously an amazing feat for a company. So it's the world's largest mining company, and we're now very proud that it's wholly listed on Australia for the last 2 decades or more. It was a dual listing between Australia and the UK. They realised that there's a lot of benefits to having just a single listing here, so they brought the listing back to Australia rather than consolidating in Europe. So we're very proud of that. So the decision was made. There's been some other great success stories. CSL, one of the world's leaders in blood plasma technologies. Okay. It was privatisation from a very overlooked, forlorn government entity, the Commonwealth Serum Laboratories, in the early 90s. I think it IPO'd at $2 or $3 a share. It's now well over $300 plus 30 years of dividends. So they've been a world leader. Back to mining, Fortescue, I think there's a great entrepreneurial story there with Andrew Forrest, the company the iron ore company that he's built in WA over the last two or 3 decades. They're probably some of the names that I always like to use as examples of that question. Macquarie as well. There's so many investment banks around the world headquartered in big economies like the US and Europe. So it's amazing that a homegrown investment bank can go international to the degree that Macquarie has and had the success that it's had. So there's some pretty good examples, I think, of I think if you look back on the share performance of all those names, the main thing is, which I put more money to those stocks 20, 30 years ago.
Listeners will, who knows,
Yeah.
afterwards, like, oh, let's check it out, actually.
Yeah.
No, thanks for sharing really, really cool stories. I didn't know the CSL one and BHP and that long-standing story. Usually, like it's quite a winner as a stock. I didn't know that been listed for so long. That story also, relocating here, super interesting.
I mean, most of those, unfortunately, most of those examples do play back to the old theme of holes and houses. I'm not sure if you've heard that expression, but mining stocks and banks. Obviously, banks in Australia, their main profit engine is through the housing market through house loans. So some people like to describe the local market here as holes and houses, holes in the ground in WA, and lending money against people's houses. But there's more to the market as well. I mean, it is a big. Those two sectors are big components of the overall ASX 200 market cap, but there's other success stories outside of that as well.
Of which you mentioned one just a moment ago. Yeah, no, super exciting, and I think also an interesting segue to what's a little bit the portrait of the Australian investor, retail investor. Just for context, you basically the ASX authors periodically the ASX Australian Investor Study, which I think it's fair to say has been the authoritative guide on the evolution of investment markets, investor behaviors here in Australia since 1986 now, so quite a lot of history there. Briefly, before we go into some of the facts, which are super interesting in that study, how is it built? If you can, let us know a little bit about that.
Yeah, it's definitely one of the things I've been most proud of since I've joined the ASX about 7 years ago, is my involvement in the most recent editions of that study. As you said, it goes back to the mid-1980s. At the time of the first edition, it was the share ownership study. Things like ETFs weren't around. There was the internet wasn't around, online trading wasn't around. So it was a very different market back then. It was pretty much constrained just to the wealthiest, most sophisticated investors had access to the share market. Since 2017, we rebranded it as the Australian Investor Study because we wanted to incorporate things like ETFs, investment companies and trusts, warrants, all the other things that we do offer, and just to get a broader picture of what people invest in, not just on ASX, our products, but also houses and commercial real estate, simple banking products.
We get to that. We have some super interesting facts here about how that all stack up.
Yeah. So we tend to partner with a specialist research firm. And we're a market operator. We're not, we understand our market and who uses it. There's a lot of advantages partnering with a specialist research agencies that can have a pool of individuals around the country that they can provide surveys to get these insights and data from. So the last couple of times we've partnered with Investment Trends, which is probably the leading firm in this area. We've got some great statisticians, data scientists there that can help us interpret the raw data. They've built up a very strong panel of individuals of varying backgrounds, wealth, etc., right around Australia. So we typically survey around about 5,000 Australian adults as the base for the survey results and all the findings that are produced in the report. It's done every 3 years is the cadence that it's been on for the last few editions. Every time there's always something new that comes up. COVID was obviously a big impact on the last two editions. When we did the 2020 edition, it was just kicking off. So we've been able to sort of bookend the pandemic in some ways. We had one of the studies, 2020 obviously was right at the very start. 2023 edition, as we've been coming out of the lockdowns and all the other implications of what the COVID-19 pandemic caused to people around the world. It's a fascinating. It's a lot of work. It takes a big chunk of my time for months on end as we're producing each iteration of the study. But it's fascinating. We get a lot of media coverage. We get a lot of interest. I think it helps a lot of fund managers when they're trying to figure out what sort of products they want to issue. I think it helps brokers understand what retail investors want. I think it helps policymakers. It helps us in our own formulation of what products we want to encourage, what sort of rules, what sort of systems we need to provide to the broader market ecosystem to make sure that people can go on building wealth in this country like they have done particularly over the last 30 years.
No, so it's a great study, and for anyone listening to us, it's available for free on your website.
Yep.
You've made like this amazing job of having some videos, that are little highlights, and you have like basically a summary. You also have like a full version. So yeah, and it's pretty exciting, definitely.
Yeah, and then we've just started our first Instagram account as ASX,
Okay.
and we're putting a lot of younger people in particular much prefer to consume information and so on through social media these days. So it's all on there as well. You don't have to go to the website or, God forbid, take a paper edition of the study. And on the website, there's also a lot of infographics, a lot of sort of summary stats as well, because it is quite a detailed, dense report to read it in its entirety.
Yeah. I must be in between. I was not on the paper version. I was on the PDF. So I was not on Instagram. I was not on the paper version. I was in between. But I think, one key fact maybe to delve a little bit into this, an interesting one that I discovered is basically now about 51% of the Australian adult population, so majority of it, holds investment outside their home and super. That's about 10.2 million adults. That's actually like a very interesting shift, because when you did the last survey, as you mentioned in 2020, before the pandemic, we were around 46%. And so when a situation of, less than half to like a majority being invested, like fascinating trend, like how do you explain this jump? How does it compare, with other countries as well? Australia as a nation of investors. I don't know if you can share some facts around that.
Yeah, we're quite pleased to see that, obviously, being the market operator, see more people who are investing in general, and also on products available through ASX. Although I will caveat that by saying that there is cyclicality in these things. There hasn't been a straight line growth over time. I think in the report we do show all the way back to 1986 how many people are at least investing in shares, and there was a huge spike in the second half of the 1990s driven by two main factors. Firstly, the internet and the availability of online brokerage accounts, and just the collapse in transaction costs that brought along. But also there was a big wave of privatisations and demutualisations in Australia at that time. So some of the most successful companies like Commonwealth Bank, Qantas, Telstra, they were all either nationalised or demutualised at that point in time. So share ownership really spiked in the 90s, came off a bit during the dot-com crash, started to tick back up again leading to the GFC, dropped again after the GFC. So there's various drivers of that pattern over time, that cyclicality that's been observed. I think the most recent drivers that have been behind the bump up in the 2023 participation levels is people had a lot of time and a lot of lockdowns. There was government stimulus. Some people had excess savings, excess money in their accounts, bank accounts, either because they couldn't go out to spend it like they normally would, or they've been recipients of government payments to keep the economy going. And also I think obviously the market had a massive pullback in the early months of the pandemic as well, so people maybe saw a buying opportunity there as well. So I think all those things drove that, and then maybe some technology as well. I mentioned the earlier spike driven by online trading. This time around, it was probably another more recent iteration of technologies. Another ramp up in social media, TikTok, Instagram become very popular over the last 3 to 5 years. Sharing information, we're all very familiar now with Zoom calls, Teams calls, podcasts. So that's probably another driver as well. Just availability of information, which I said at the outset is a big driver of efficient, well-functioning, deep liquid markets. It's just information sharing between individuals.
And the interesting thing you mentioned before is inside that picture is also like what is driving the bump, right? And you mentioned, as I was saying, the rise of ETFs. Maybe for our audience, before you go into this, I find the picture quite interesting in terms of holding preferences. Direct holdings of Australian shares come first, with 58% of investors being on that type of assets. Residential investment property, we talked about it, always a big hit at around 35%, followed by term deposits around 28%, and ETFs at 20%. Now, what's interesting is obviously the moving pieces, knowing that residential investment property dropped by 4 percentage points between 2020 and now, While on the flip side, ETFs gain a 5 percentage point share, which, knowing that they are 20% today is an incredible rise. How do you explain that thing? Why has it become so popular?
I think, in essence, it's the cost of admission. I mean, Australians love property, and I think if most people had a choice, their first investment and their second, third, and last investment would be property. They love the tangibility of it. They love going around and having a look at it, and, not tapping on the walls, stomping on the floorboards to make sure people love that. Particularly more conservative people. That bricks and mortar it's about the most basic investment opportunity you can explain to people. You buy. We all need some very basic needs: food, shelter, and shelter is an investment as well. So, but the problem is the cost of admission is just so high now. Even a basic in a capital city like Sydney, even 1-bedroom apartments, the deposit on a 1-bedroom deposit is a substantial amount of money that can take. Particularly a young person, maybe just starting out in their career, it could take many years or maybe more than a decade just to save enough for a deposit. So to me, that's the main driver. Whereas ETF, $500, that's all you need, and you can start from there. And I guess it's the cost of admission is the primary driver, I think, but secondary is just the what's underneath the wrapper. Like younger investors love having access to tech stocks. Australia is always at the very, very top of global league tables when it comes to adoption of new technologies, be it internet, mobile phones, smartphones, all those things. So we're pretty savvy when it comes to using technology and wanting to invest in the underlying companies that provide those technologies. So ETFs are a great way. We out of 300 ETFs, we probably have dozens that would tailor towards a particular tech theme, tech thematic or sector. Either primary, like just the ones that focus on the NASDAQ index, for example. I mean, the NASDAQ 100 is not all tech firms, but a big chunk of it is. And then we've got like very, very narrow base thematics that might just be invested in EVs or batteries or lithium that obviously are key inputs into new technologies like electric vehicles and things like that.
Interestingly, do you see, because you mentioned you have this spectrum of 300 ETF products, do you see some form of concentration, such as, effectively like 80% of the purchase orders go for 10 ETF products, or is it more a nuanced picture?
I guess it's almost by definition, as the number of products has grown so fast over the last few years, we have got a long tail now, whereas before it was much more concentrated in just a handful of products. But that's only a lot of that is just because they're very new products. They haven't had time to develop. I mean, for most of the time I've worked here, we typically bring on 20 to 25 new ETFs in any given year. Last year we brought on 50 because there's just so much latent demand from product issuers, from fund managers to get product on the ASX. So it'll take, and this year we're probably tracking similar sort of numbers. So it will take time for people to understand what these ETFs are offering, for the issuers to market that, to have a track record. A lot of times people will only want to invest in an ETF they can see the 3, 5, 10-year record. We've had ETFs on ASX since 2001, so that initial batch that have been around 20 years, they're very well known, they're very well understood, so they typically are the biggest ones. But we also see products that have just been launched in the last few years have also gathered quite a lot of assets already. But the ones that are sort of north of 1 billion on an individual fund basis, there's probably out of the 300, there's probably about 20 or 25 that have had that level of success.
No, super clear. Okay, it's pretty cool. So you have this cohort effect. What you're saying effectively is, look, you cannot judge it on a snapshot. You need to wait for this graduation to happen.
Yeah,
fair enough. Yeah, and you hinted at it a little bit as well. The so-called new generation. Maybe you can help us define a little bit what that is partly behind the boom of ETFs.
Yeah.
Maybe here, and I don't know if that's a paradox or if it's in fact the expression of a certain luxury of choices, because the new generation is seen many times as being quite, risk friendly. With cryptocurrency, for instance, they tend to, really like to pick those swaps, which, will have a bit more uncertainty. But there are also the ones going ETF, which you would believe is, supposed to certain risk aversion. How do you explain that? That polarization and, sort of new generation being on both fronts?
Yeah, it's a real paradox. I mean, it's evident in the data, but unfortunately, we don't survey. There's a limit to how many questions we can ask, as we all know. We get.
Sorry, I ask a lot of them.
We get. How many surveys do we typically all get on a day? You buy a coffee in the morning, and there's a request for a survey in your inbox by the time you finish drinking it. So we know that we can only ask a certain number of questions in our survey. So sometimes we just want to see the data, and then the insights, I guess, is left open to interpretation by the readers or the users of the study. So there's definitely a paradox. The data clearly shows that there is a paradox between younger investors are quite risk averse, but do seem to love nascent investments like cryptocurrencies, which are obviously highly volatile. My personal take on this is it's driven by almost like, what's the word, compartmentalization. I think that they have sort of two pools of money in their head. They have their investing money, which they want to be quite conservative with. Most people's ultimate investment goal is for the first half or first 2/3 of their life is to own their own home. So their investment pot is to get them towards that goal. I think they also have like a fun pot of money where they don't mind, shooting for the moon, or what's the expression, diamond hands or YOLO, all these sort of expressions that really gained some currency over the last few years with GameStop and all the gamification. So I think there's a compartmentalization going on, which is not inconsistent with behavioral finance theory, that people have certain heuristics, certain biases in how they approach decision making or financial or mathematical choices. So I feel like it's something that's happening there. There's two pots of money in people's head, and that's how they reconcile internally between why they want to be so conservative in their investing, but quite risk taking in things like putting money into cryptocurrencies.
When you put it like this, it's less of a paradox. The paradox becomes the older generation, which tended to be a bit, like mono approach in the way they were doing things. So you're basically saying, no, look, actually, like this, it's kind of normal. It's like an inherent natural contradiction that we have. Or it's not a contradiction. It's just the expression of what we want, right?
Yeah.
Maybe as a last topic around this survey, and then we'll get to our classic Upworth section around your investment philosophy. But as a last topic, I'd like to explore and shedding light on that subject, the gender gap. Basically, your study points to an encouraging trend in that out of the 1.2 million investors who started investing since 2020, so new investors, quite a large cohort, which we mentioned before, half of those are women, right? However, as a whole, only 42% of investors on exchange investments are women today. So there's a bit of a disparity here between the current state and the dynamic. What's interesting is that it is no secret that women tend to be less invested than men. Less known, I think, is the brutality of the wealth gender gap, and we're doing a bit of research that we wanted to share here before. According to the Federal Reserve Bank of St. Louis, white women in the US own 50 cents for every dollar owned by white men. If you take now black women, on average, it will be 5 cents. This is brutal, and your study brings great insights around some of the reasons behind this huge disparity, such as the income gap, the difference in risk appetite. Could you share with us, some of your findings? Because there's like great section around this in your report, in your survey.
Well, I think it's just very much a generational thing. As people get older, they're less willing or less able to try new things. So it's really encouraging that we're seeing pretty much exactly along the distribution of genders, which is obviously pretty much 50-50, or I think if you were super precise, I think it's 51-49. So we're pretty much there in terms of new money coming in. So that's great. So that sets us out very well for the long term. Unfortunately, it will be the long term. This is going to take a lot of time to change due to generational inertia. As much as I'd love to hope and think that that disparity will also equalise in the older parts of the population, I just don't think that's feasible. Unfortunately, previous generations were much more dominated by by the male half of couples. They took the financial decisions, etc. I think that's very, very hard to change and for people in their 70s or 80s. But what's really key is, the new generation is coming through. The current people just don't have the career, or there's a lot more equality there, a lot more income equality, a lot more educational equality, and other things that drive investment. Because at the end of the day, investing, I think, is very much a confidence thing. Confidence tends to be driven by practice and by education. So I think all the building blocks are there for that trend to continue, but it will just take time before the whole pool of investors is a better representation of society as a whole.
Fair enough. And you think like additional actions could be taken, or like is there any initiatives that could be basically shared to accelerate that trend? Or
well, I think we're seeing that there's some other podcasts or other ways. Like I think a lot of women, when they first start investing, they quite like the company of other women. So we partner with firms like Ladies Finance Club and similar firms like that do target towards women investors. We run a lot of educational seminars and stuff, and we do see that men probably are overconfident. They're the ones asking more questions, the ones that typically take more risk in their portfolios. So there's probably on the education side of things, there might be the opportunity to present education or things like that that are purely focused on women. But we tend to take the approach, look, the young women that are just coming out of university or schooling, they've had equivalent education, equivalent opportunities. They're brought up with it in a society that's much more equal now. We're seeing that through not just finance, but other things. The amazing success of the Women's World Cup recently. Young women feel like they can do anything that men can do. I think that's pretty becoming more and more clear. So, like I said, I think it's just a question of time for that. As depressing as it sounds, it's basically just the older generation dying out, leaving money to younger members, and then that the allocation of that inherited wealth will be driven by decisions making by men and women equally.
Which is happening. I mean, it's an entire other topic. Is a huge one. Like this generational wealth transfer, which is once in basically centuries, like the size of it. But super interesting. And then you said like the trend is now like more equal. I guess there's still a lot to be done probably on like the income parity, which is where the gap comes from, because we mentioned the volume of investors, but we didn't get into the volume of money being invested by those investors, and there is a gap there, right? I mean, like men tend to hold like more monies than women do, and they invest more also as a result of being paid more, generating more cash, I guess.
Yeah.
But on that topic, look, moving on to the investment philosophy, I guess in that last section, it's a bit of an open question for you. How do you approach investing as a whole? Like, what are your goals when you invest? What is your philosophy that you can share with us?
I think in simple terms, I try and make it fun but not too exciting. If your portfolio is too exciting, you've probably got too much risk in it, particularly in a reasonably quiet time like we are now. So, I love reading about investing. That's the
any book you recommend? Like if you like, that would be super interesting for audience.
There's probably a few. Things like A Random Walk Down Wall Street is a great one. Lies Poker. Maybe not always teaching the right lessons. I think a lot of Michael Lewis's books touch on the finance side of things. I've always liked
Flash Boys was one, I think.
Yeah, Flash Boys, The Big Short. I've always been really interested in behavioural finance. Richard Thaler, Danny Kahneman, Amos Tversky sort of books on decision making processes are amazing reads. So they're the sort of things I like to read. But so I guess again back to diversification. I know that you've got to eat your broccoli as well as your filet mignon. So you want to make sure you've got some.
What's the equivalent of broccoli in investment? What's your filet mignon?
Fixed. I think the broccoli is the muesli is your fixed income and cash. You always want to have a decent proportion, no matter what age you are, in those things. Sometimes just take opportunities, right? It feels like equity markets are always overvalued. Everyone's always complaining, stocks are too expensive. So, but very inevitably, the market always seems to march higher, at least it has done for most of the last few decades. So, but if there's pullbacks like there was in the GFC, it's good to have some dry powder, to have some money just in cash or in fixed income that hopefully you can, if you feel like there's more opportunities in growth markets, you can reallocate at that point. But you definitely don't want to see your portfolio. My opinion is you don't want to see your portfolio bouncing around more than what the equity index is. So if you see the nightly news that ASX 200 or S&P 500 was up 1% or down 1%, but your portfolio was down 3 or 4%, you're probably taking too much risk, right? Because that's a pretty simple. Even though those indices are already reasonably diversified, they're still equity indices.
Too much vitamin A.
So too much vitamin A, which obviously, as we know, too much red meat can lead to, tastes good, but can lead to some bad health outcomes. So it's the same with your portfolio. You should never be too over allocated to one particular asset class. Although, having said that, last year all asset classes went down simultaneously, which is pretty rare. 2022 was a really tough year for investors. This year, better, but not massively better. Sometimes there's no place to hide, but usually cash and fixed income are decent places to hide when the world turns nastier. So that's my overarching philosophy is make sure I'm always comfortable with the level of diversification. And comfortable when it's quiet. You don't want to be making these decisions when the market's already very volatile, because then, as we talked about earlier, that's when liquidity dries up, transaction costs go up, people get very nervous, you tend to make worse decisions under stress or when the markets are whipping around. You want to make sure your portfolio's in good health while things are quiet.
And I think it's a great segue to the standard Upworth question, which is what does your portfolio look like? So we don't want to know the numbers, we don't want to share them either, but it's more a matter of split by asset class, broccoli, maybe some carrot, I don't know. But basically how, by asset class, how are you invested? Just to share with you, we had some very interesting, we love this question because we had some very interesting answers to it. Sometimes, some of our invited told us, look, I'm all on basically startups. We're like, wow, that's pretty aggressive. Good on you, but phenomenal, approach. So back to you. What's your basically what's your split?
Well, there's a very old expression, very old saw about you should invest your age in defensive income, defensive assets, other fixed income. So, i.e.,
we don't want to know your age.
i.e., if you're 20 years old, you should only have 20% in defensive assets and 80% in growth assets, like
it's a good rule of thumb.
Real estate. That's a very old one, so I'm not sure if it holds up to the empirical testing or not, given that the world's a different place in terms of inflation, interest rates these days, for most of the last few decades compared to what it was, say, 50 years ago. But that's not a bad rule of thumb. That's roughly what I target. I'm probably weighted a little bit more to the filet mignon side compared to the broccoli side at the moment, given my age, but not a million miles away from that. So I think that's a pretty easy heuristic to teach people when they're looking at their portfolio.
For our listeners, you'll have to Google up Andrew's birth date to get a sense of what that can look like.
It can be tough when markets are rallying hard, and obviously you have that approach. You're going to underperform. And, you look at the S&P being up 30% in a year. And you think, oh, hang on, my portfolio's only up 10, 15. I've left a lot on the table there. But at some point, there's pullbacks, and then you feel a lot better when the market's down 30% and your portfolio's only down 10%. So you just got to you've got to take a long-term view more than anything. Don't get too focused on what a particular index or a particular stock has done over the last few months or even the last few years. You've got to take a long-term view and just always remember the power of compounding, and that power cuts both ways. 10% return every year is great, positive, but if you have a 50% return negative, you need more than a 50% positive return after that to get back to square. So it's a powerful force, compounding, but it cuts both ways.
And saying, so basically, you're hedging defensive assets, and then are you properties? We mentioned it's like the second preferred investment of Australians, 35% of their holdings. Are you basically like the standard Australian, or are you something that you don't touch, or?
Well, apart from my own home, which that's sort of separate. I think that's just a standard that you have to have. I actually do have an investment property in London from my time living there.
Yeah.
But to be honest, I hate investing in property because just the hassle of the admin involved, the uncertainty of tenants moving in and out constantly. It's London's an old city, and most of the housing stock there is quite old. And this place, I feel like I'm constantly paying for for repairs. I'd be meaning to sell it for a while, but I don't find it particularly exciting. Some people really love property and going to look at them and trying to figure out which suburbs will perform, underperform. But I just
not yours.
I'd rather read up about emerging technologies, emerging companies, and invest in equities or fixed income. To me is much more interesting, and it's a lot less. There's a lot less maintenance involved in terms of the admin. I'm not a huge fan of property investing. I mean, through equities, through REITs, etc. For sure, but physical property, by its very essence, it's massively illiquid. If you have a major emergency life event and you need to get your hands on cash, obviously, it takes months typically to sell a property. Transaction costs are ridiculous. I can't believe how much real estate agents charge, particularly in this country, to sell a property, but also to manage a property. Like the fees, the transaction costs, I think are just way too high property compared to other things like equities. You can buy $100,000 worth of equities for probably $1,000 in brokerage, $10,000. It's not in my head that quickly, but you sell $1 million property, you're looking at tens of thousands of dollars in transaction costs. I mean, if you've done well at the property, if you've held the property for 10, 15 years and it's doubled or tripled in value, you're probably not going to get a care. But to me, I think north of 2-3% total transaction costs is crazy when it's usually 10 basis points for an equity brokerage.
Yeah, it's very interesting lens because I think most people don't necessarily compare like for like, saying what's the transaction cost on equity and the transaction cost on a property, right? So something that people tend to forget. As you said, they get excited with the physical piece, and don't necessarily do it like for like. It's a pretty cool comparison. Like maybe following that thinking. Many times you hear arguments about people wanting to leverage themselves, which is a powerful way of creating wealth, which typically can be easier to access through a mortgage than it is through marginal lending. Yeah, how can you help people navigate this? Because that's a fact, right? I mean, it's not that easy to get margin lending from bank unless you are high earner.
And there's a lot of idiosyncratic risk in property as well. You might buy a house that looks great and you're happy with it, and then the next day they announce a plan to build a freeway 2 streets away with a smoke exhaust stack, and then all of a sudden people probably aren't going to be as keen to buy that property. I mean, if you're super wealthy, that's fine. You can buy multiple properties, but again, it all comes back to diversification, right? If your investment portfolio is one investment property, sure, the bulk of the returns will come from the whole market going up, but there's still some idiosyncratic risk there. Particular suburbs may end up being, may gentrify. You might be lucky to buy into a suburb that's considered not so attractive, and over a period of time, who knows, maybe a lot of new infrastructure is built there, new cafes, new amenities, and it outperforms the suburb 3-4 kilometres down the road, but it can also do the opposite, and you can be exposed. To some idiosyncratic risk, or the case that's got a lot of media publicity over the last couple of years is when there's been really poor construction and it's a new apartment in a building that hasn't been built to a high standard. We saw some properties that were had to be evacuated. I know that's a very dramatic edge case example there, but if that's your only investment, you could be massively in the hole by the time all the remediation work is done to the property. Whereas you buy a diversified ETF, you're not going to have those particular issues.
So we diversify for what you were saying before. Maybe as a conclusion, and we had great conversation around range of topics. Thank you so much. What will be valuable lesson or investment rule that you like to share that you wish you had known before?
Oh, that's a very simple question. Just start early. Again, back to all these. I'll be very repetitive here around things like diversification, but compounding as well. Get that compounding to work as early as possible. I've already got my young children investing. Although when I say investing, it's my money that they're investing, so it's not their own. But I'm hopefully going to demonstrate to them by the time they're young adults. We'd be putting a bit of money in every year into into your investment account and look how much it's grown to. And hopefully that's going to be enough that they can buy a car or travel overseas or deposit for a for their first property. That's the key. Is don't leave it too late. Start investing yesterday. Would be my
super cool. Pretty good punchline to finish. Start investing yesterday with a bit of broccoli and filet mignon in summary. Oh, thanks a lot, Andrew. Thank you so much for having us here at the ASX and spending good chunk of your precious time with us. I think it was a great conversation, and hopefully our listeners will think the same. Thank you so much.
No problem. Thanks again.